Welcome to Truflation.com Spaces. We're set to discuss the Federal Open Market Committee and Fed Chair Powell's eventual presser today on whether rates will be hiked and what it all means. We're getting micro. We've got investor and trader Jonah Lupton of StockTwits seeking alpha and Lupton Capital to talk CPI, the economy, FOMC, rate hikes, Q2 earnings, valuations, and some of his favorite stocks going into the back half of 2023. You can find more of Jonah's work out at luptoncapital.com. So glad you can join us today. We also have and we're honored to have from the Israeli Blockchain Association, a vibrant, fast expanding network of blockchain professionals, investors, business leaders, and policymakers, and that would be none other than its executive director, Yosef Shaftal. You can learn more about the Israeli Blockchain Association out at blockchainisrael.io. Today's Spaces, of course, is sponsored by Truflation Premium. It's the perfect way for institutions, businesses, investors to be one step ahead of stale, lagging numbers, and instead allows those who want to stay in the know to access granular, real-time data from millions of points. Surf over to Truflation.com, click the black download data button, and select a plan that works. After more than 1,400 votes, the Truflation X followers overnight poll shows that 77.5% of the Truflation Nation expects rates to be raised today, and that's slightly more skeptical than the CME's FedWatch tool, which pegs it at something like a 98.9% certainty. Whatever the case, Jay Powell has a real predicament on his hands. Booming stock market, looming labor strikes, taking inflation, food supply chains face disruption in Russia, Ukraine, and a 2024 national election season that is heating up. Do you think Jay Powell is daring enough to spook markets and go against forecasts? Today's FOMC is the last before a break, and they won't return until September. After 10 straight raises, he and the Fed paused last month. And as we're speaking, the eyes of the financial world are on that man. Is he him? He him. Let me go ahead and after that dramatic intro here and move all of our guys into speaking and get you up here. We love having listener questions. You can do that a bunch of different ways. One is to get in here and use the mic in your app at the bottom left-hand side there. You can just request to speak. Once you're on, do us a favor and mute yourself. That way we don't hear any background noise, blah, blah, blah. And then we will call you up. You can also, of course, add us in the comments section. So do that, please. Basically, just go below our Spaces link there, and just add the questions, and we'll get to you as soon as we possibly can. With that background, with all that's going on, we first turn to the Truflation team, and that is no other than our head analyst, Oliver Roost. Oliver, thanks again for coming back on, man. We really appreciate it. What's your take? What's your call on today's FOMC and Powell presser?
Hi, good morning, everybody. Good to be on the call with everybody again. I think it's pretty much, the market's pretty much expecting a significant, with a significant bias that the FOMC is going to be increasing interest rates by another 25 basis points after that meeting. But I think that's the major news, which is not really major as everyone's baked that into the market. I think the more interesting news is actually, is this going to be the last interest rate hike for the year? Or are we, and how much longer are we going to keep these open, or are we going to see some reversal of trends? And I think that's much more the interesting question that we're in. And I think the Fed is at a pivotal moment right now, after having a year of virtual solid agreements across the FOMC voting members and non-members that they should be increasing interest rates to curtail inflation. Now, I think we're starting to see significant differences amongst the voting members and non-voting members about not only about hiking interest rates further, but also about how long to keep them elevated. So if you want, I can give you a bit of a diagnosis on that and my view, and then we can take it on from there if you want.
For sure. Yeah, we noticed that you're quite the sought out analyst. I've seen you all over the press account. So yeah, do dive in.
Okay, thanks a lot. Yeah, very kind of you to say those words. Look, I think there are three major buckets in the FMOC. For those who don't know, there are 11 voting members and 5 non-voting members. And in essence, I think you can categorize them into 3 buckets. One is those individuals that are continuing to believe that we need to increase interest rates further to curb inflation. And there are about 4 individuals, 4 voting members, and then 1 non-voting member that believe that. There's Christopher Waller, Michelle Bowman, Laurie Logan, of course, and Neil Kashkari. They're the 4. I would say I would bucket them into that group of individuals that believe there's a need to increase interest rates further to curb inflation. You then have these centrist groups that are sort of middle of the ground, and I think Jerome Powell is the leader of this group with his co-partner John Williams, the New York Bank. You got Michael Barr in there as well, and you got 1 non-voting member, right? And their belief is similar to those that believe that increasing interest rates further, but they believe, look, the labor market needs to weaken to contain these price pressures. And then, of course, you got those individuals that believe we need to stop the hike increases and actually start to reduce the interest rates. And I think, you got those people like Austin Goolsbee in there, Lisa Cook, and Patrick Horker in there. And surprisingly, out of the 5 non-voting members, there are 3 in this camp. So in my view, right, they might have different views, but that's sort of what I bucket them in. And the divide amongst these 3 groups has now been accelerating especially the last couple of weeks, and for about last month or 2, the divide between them has certainly arisen. And I think, if I dive a bit deeper into this, you can argue, look, the inflation rate has dropped down to 3%, but the real inflation, if you take out food and energy, which is the core, is still sitting at 4.8%, right? And these believers of increasing interest want to get that under control. As much as we are seeing the cost of goods coming down on inflation, the price of services is still increasing. And that's in part been driven by the tight labor market. Unemployment's still at 3.6%. The next result, unfortunately, is out on the 4th of August, so it'll be post the FOMC meeting. But expectation, again, is for that to stay around 3.6, 3.7. Wage inflation is still holding at 5.7%. And, of course, you have the last economic GDP numbers that came out for Q4, which was for Q1, which was the 3rd estimate at the end of June. And that was at 2%, right? And part of that driven by the increases in inflation. But the Q2 numbers is released tomorrow. So that will be quite interesting to see if they do change their viewpoint and tone on this in the messaging of what Jerome Powell says. And the third thing is these real, if you want to call them hawkish individuals, in my view, are concerned about is the interest rate sensitive housing market is still seeing prices moving upwards and activity moving upwards, despite the higher 15-year or 30-year fixed mortgage rates. Obviously, the centrists want to bring it down. They're concerned about the labor market, so they want to find ways to contain that labor market. You've seen the unemployment numbers I just mentioned earlier. I think the 2 other factors here to mention. One is the consumer confidence. The consumer confidence numbers are released by a whole variety of different organizations, including Truflation, is seeing these consumer confidence increasing for the 2nd time. It's a significant increase in June and another significant increase in July. right? And this is coming across all age groups. It's coming across all income groups, although to a greater degree, the individuals beneath an income group of 75,000 US dollars, so i.e. those in the service-based sectors. And second of all, the other factor with the consumer confidence is also driven by the tight labor market and inflation coming down. That's boosting people's morale and people's confidence in there. I think the other thing to mention about this is the earnings season, right? We've seen a lot of earnings companies coming out and releasing their results, more to come. But a lot of them have delivered some fairly positive reports. So yes, is it partly due to inflation? But you're also seeing companies like Amex, Visa, MasterCard reporting their consumer-based numbers, and they're starting to see increases as well. So, I think they're positive signs across the board. And I think, the centrist viewpoint is they want to see that demand ease through the labor market. So I think they will be pushing probably a hold factor for a bit longer. But none of these guys so far want the economy to go into a recession. And I think you got the final group of individuals, right, which is, those individuals that want to see inflation, to see the interest rates not increasing any further, and probably start to come down faster than they had anticipated. So, their viewpoint is obviously, inflation is coming down. But in particular, their viewpoint, in my view, is that the monetary policy works with a long lag. And they are, in my view, they're of the belief that the impact of the tightening of monetary policy really hasn't been noticed, because the estimate is anywhere ranging from about 9 to 12 months, right? Sometimes some individuals believe it's even longer, right? If you leave Bostic, he goes up to 18 months. So that gives you a bit of an idea of their viewpoints. The key message, I think, for this Fed meeting, this FOMC meeting, is it's going to be a 25 basis point increase. I think that's pretty much baked in. The question is, for me, the key focus point and the key area to look into is the messaging that Jerome Powell will be talking about at the conference to determine how much longer that's going to go out. There's obviously people still expecting another 25 basis point in the September meeting, given that we don't have a meeting in August. But my viewpoint and the viewpoint of Truflation is that I think that if inflation number comes down, the GDP hold starts to be impacted a bit. I think you'll start to see a hold factor coming in for a bit longer, rather than further increases in subsequent meetings. So I hope it gives everyone some context. But I'm sure others got other comments to add on top of that.
You're listening to Truflation.com. Ahead of today's FOMC meeting and Paul's press, we do always open it. So request us in the app, the little lower left mic there, or you can just at us in the comment section of today's Spaces link. And with our guest speakers, we also have the Truflation team, including CEO Stefan Rust. Hey, Stefan, thanks for coming back on. With all you've heard, what's your take on today's events, do you think?
Yeah, I think all of us summed it up. Thanks for being here, and always glad to be on a Truflation Spaces. So, just as all of us summed it up really well. There's not much really to add. I think the scary thing to me remains that the fact they're blaming a lot of the rate hikes with employment and new jobs being created and the lack of ability to fill open positions. As most of us know, a lot of us are filtering through new candidates a lot more. As a result, you're keeping positions open and you're announcing open roles a lot more. But the scariest thing is in the first 6 months of this year, guess who was the biggest employer and bringing on some 300 plus new employees, close to 400,000 new employees? The government, running and operating at a $2 trillion deficit. They're still the biggest employer by far. I mean, they're greater than any of the other industries combined, from transportation industry through to, the retail industry, financial services, etc. The government, by far, with close to 400 new employees in the first half of this year, is the biggest employer in the US. Second is the healthcare industry, which, by the way, is also, you could argue, a public service sector. And as a
Right.
result, ramping up the cost. So, I mean, to me, it's fun. What's the saying? I beg from Paul, I steal from. I don't know what the saying is. But on the one hand, my left hand is taking money from everybody and giving it to the hand that feeds the debt even more.
Yeah, it's a bit of an accounting fiction too, um, like with regard to taxes and how all that sort of shuffles out. Um, Government workers are, taxed. I put that in quotes, and that there's just kind of this weird kind of trading of tickets back and forth that very very strange. But yeah, I don't really hear that much. So that's the kind of insight you're going to get from a Truflation Spaces, which of course you're listening to Truflation.com Spaces, and this is our look here at what we think will happen in I guess it's a 2-day meeting in the Eccles building there in DC. Today's FOMC meeting and Powell's presser, which is scheduled for 2 p.m. Eastern. We'll probably live tweet that as well today if we've got some time here. Again, we open it up to questions all the time from listeners. You've got an all-star panel. If you didn't hear us in the beginning, we are lucky enough to have Jonah Lupton of Lupton Capital, investor trader, with us to give us his perspective, and then a more kind of global look from Yosef Chantal of the Israeli Blockchain Association. And that's as good a segue as any to bring Jonah in. Jonah, thanks so much for coming on, brother. We really appreciate it. With all you've heard, how does the Fed, sort of factor into your calculus? Like what do you use it at all when you're making decisions? Like what's the micro take?
Yeah, so I'm. Thanks for having me. I'm not a big macro guy, but I think whether you're an investor or a trader, you need to follow this stuff. The FOMC is more important than ever. Obviously, the last couple of years have been dictated or driven by liquidity created by the FOMC. So you do need to pay attention to macro and what the FOMC is doing, saying, whether we're in QT mode or QE mode. But with that said, I mean, so just so everyone's familiar with what I do, I run 2 portfolios. I run a investment portfolio, 20 to 30 stocks, mostly focused on the companies with the strongest fundamentals. So my biggest positions there are companies like Celsius, Uber, a company called Lantheus, Shockwave Medical, et cetera. And then I run a trading portfolio, which is strictly based off the technicals, volume, price, momentum, et cetera. So you do need to pay attention to macro. With that said, coming into this year, I thought we would see headline inflation below 3% by the end of the summer. It looks like we're probably going to get there. But now, of course, everyone's focused on core, which I think is a little funny because last year, when gas prices were ripping higher, food prices were ripping higher, nobody was talking about core. Everyone was focused on headline inflation. I remember being down in Nashville, Tennessee last summer when gas prices were peaking, and now gas prices are down probably 50% from there. Food inflation has obviously cooled off. Shelter has cooled off. So, we now have a headline CPI number of 3%, but now all of a sudden, nobody cares about that. They're all focused on core. So I keep a spreadsheet for core and headline, and we all know. So right now we're at 3%, and we saw a big drop off in year-over-year numbers because we were coming off a 1.2% number last June, and then we got 0.2% this past month. So I mean, easy math. We were at 4% a month ago. Subtract the difference between last June and this June, and you're at 3%. Last July was actually a 0 month-over-month number. And then we got 0.2% in August, 0.4 in September, 0.5 in October, 0.2 in November, and 0.1 in December. So if we right now we're at 3%. If we average month over month 0.2% for the last 5 months of the year, that'll put us at around 2.8% year over year. I don't think that's low enough for the Fed to start cutting rates, so I don't think anyone should be anticipating rate cuts anytime soon. If we average 0.15%, so let's say we get a couple 0.1s, a couple 0.2s, then we're at 2.5% year over year by end of year. Once again, probably still not low enough to have the Fed start cutting rates. So, we're going to be in this, higher for longer period. It seems like the market is able to to digest it. Like the first guest said, it's just these lag effects. And at what point does the economy really start to struggle? Do the higher rates start to strangle growth? Obviously, we've seen loan volume come down. Credit markets seem to be holding up, but I think banks are lending less money. I've heard that. I don't follow this stuff as closely as some other people do, but I know rates for small businesses have certainly gone up. I think they're now in the double digits for some small businesses, which is going to hurt growth as well. And as the first guest said, I mean, we're still doing some hiring in this country, but it's the government that's doing the most hiring. So, I don't know if the private sector is really as bullish as the government is in terms of adding new people to their payrolls. But with that said, I mean, I think coming into this year, a lot of people were bearish, and I think they've had to start throwing in the towel, like Mike Wilson sort of did this week, because the labor markets have held up well, the economy's held up well, earnings have been pretty good. I think Q1 earnings were definitely better than expected. Now we get into Q2. So, I mean, like, I'm personally a little bit more bearish or cautious in my portfolios just because we've had such a massive run up in stock prices, valuations, multiples. I just think there's a lot of companies that have run up too fast, too far, and Q2 earnings are not going to justify that multiple expansion over the past 3 to 6 months. So I think if you have big profits in certain stocks going into Q2 earnings, you probably want to start taking some profits, or at least, hedge your positions.
Fascinating stuff, man. When you were citing some of the data there, and to the Truflation Nation, the BLS stuff is certainly something that most people pay attention to. But we've had kind of a mutual admiration society between you and I, or you and Truflation. What's your take on the Truflation number, which, if memory serves, is around 2.5%? Does that serve you when you like? How, I guess what I'm trying to ask is, how important is getting a variety of data and also getting non-government related data and real-time data? Do you use Truflation? Is it something you look at?
Oh, for sure. Yeah. I mean, I see you guys popping up in my feed every day with your new numbers, and I think it's extremely relevant. I mean, I think the more data you can use, the better. And I don't know if I even trust the government and their number. And I think a lot of that government, when they put out these reports, it's based on stale data. And, shelter, I know for a fact shelter has been coming down because I see people in my building that recently signed leases, and those leases are, the prices are 10 to 15% cheaper than they were a year ago. I mean, we've all seen what's happened at the gas pumps. Now, I don't know if, I have friends that own restaurants, and they say that food prices have come down, their costs have come down. I just don't think we're really seeing it. I mean, I can't remember the last time I went to a restaurant and saw prices on the menu that were cheaper than, 2 or 3 months ago. So I think some of these prices are going to be extremely sticky. I mean, I think, food and energy is obviously the most volatile, and that's why people do look at core instead of headline. I just think it's a little disingenuous to suddenly, last year no one cared about core, and now all of a sudden they do. But
Yeah.
But yeah, I agree. I mean, I think you guys probably have better. You probably use better data than the government uses. Your data is probably more up to date than what the government uses. So I do think Truflation is probably more accurate than those monthly numbers we're getting out of the BLS.
I mean, obviously we think so, and it's always good to hear from traders like yourself that we're actually providing some valuable insights. But I think, coming back to your point, I think a lot of people, sort of have experienced over the last 2 to 3 years a huge price rise in the cost of living. And as a result, maybe we still see a small growth, but the growth is now dropped to 2%. It's still a growth, right? I don't think we're going to see when will prices come down? Only when people don't travel anymore and we have occupancy rates at 30%. Then maybe you'll see prices come down, layoffs will happen, but that's when we're hitting a big time recession. And if what we're forecasting is that we won't have a recession, or it'll be a soft landing, according to some, then prices won't come down. That's for sure.
I mean, it's just wild. Like, never in a million years would I
exactly.
imagine that the FOMC would obviously start raising rates later than they should have, and then raise rates by 525 basis points over the last 15, 16 months. And yet the stock market took a nosedive last year. But I mean, we're not that far away from all-time highs right now. And the FOMC hiked rates 525 basis points, and we still have an unemployment rate around 3.6%. And the economy seems to be holding up pretty well. And it's surprising how resilient the economy has been and the U.S. consumer has been. I mean, just look at all the airlines companies that have reported earnings already. I mean, they're all reporting record numbers. So the consumer is holding up very, very well. Even through a tough inflationary period. Now, maybe that's because they had more savings left over from the pandemic. And now you're seeing some of those savings balances whittle down. You're seeing credit card spending start to tick up. But I mean, it's hard to think that we're going to run into a recession anytime in the next 6 months, as long as the consumer's out there spending money. I mean, look at Hilton this morning. Hilton, I didn't look at the exact report, but I saw someone tweeting about it. I mean, I believe Hilton reported great earnings this morning and raised guidance. So people are out there spending money.
Yeah, it's definitely a new world. It's a new economics. There's obviously classical theory to pay attention to, but there's also some strange empirical data where you kind of just scratch your head and kind of wonder if it's going to work itself out. You remember Truflation? Go ahead.
Yeah, sorry. But remember, I think you hosted a Spaces. I think it was 2 months ago, and Oliver had predicted and had seen, based on the Truflation employment data and market data, that prices in the hotels had gone up. Occupancy rates were back at the level that they were pre-COVID, shy by maybe 100 to 200 basis points, right? And the only thing that was going to throw this out of the park, which is coming back and confirming, Jonah, your argument, Hilton is forecasting and predicting even more growth in the next quarter, right? And so why? Because of as Oliver highlighted, what did you call it, Ollie? Revenge travel, revenge events, revenge binge eating, right? So everybody was going out having been locked down, and now everybody's going out and doing the revenge element of the opposite to that lockdown. And so, yeah, just those insights, I think, yeah, coming back to the point, Truflation just has awesome data. I'm biased, though, I'll admit that.
No, I do have a couple friends. I have a friend that owns a restaurant in Boston and a friend that owns a restaurant on Cape Cod. And they have said that this summer is not quite as busy as last summer, but I'm not sure what to read into that. I think maybe last summer was just so insane. The revenge travel, everyone trying to get out of their houses after the pandemic. Maybe some of that's cooled off a little bit. But, I mean, they still said it's very strong, just not quite as strong as last summer.
Yeah, I think just to add on top of that, Stefan's right. We called this out a while ago on the Truflation data, the analysis we're doing. I think you can also, even beyond looking at hotels, have a look at flights, right? And you just have a look at the earnings reports being released by American, Delta, and United. They're all really positive earning numbers. And actually, if you look into that, not only they're positive and their guidance numbers are increasing, actually, and this is a great indicator, have a look at their booking numbers, right? And they have generally they're pretty good forecasts out for the next 3 months of what their flight capacity looks like, especially on the passenger. So this data is not available on cargo, but let's put it on the passenger number. you're starting to see the booking numbers are looking pretty solid for the next 3 months, right? And of course, the prices of tickets going from the U.S. to Europe right now are astronomical. Even within interstate is increasing versus this time a year ago. So not only are you seeing a pickup in demand, you're actually seeing prices increasing on top of that. And so, I think we're really into this revenge thing, revenge behavior. The other thing is, as much as everyone talks about we're going into recession, I'm of the belief that we have consumers have become increasingly more. They've always been relatively comfortable with this, but increasingly so nowadays with the notion of carrying debt, and the level of debt that people are carrying are increasing, right? And so not only is it now the older generation have got a mortgage debt, but the total household debt, right? The credit card debt's increasing, auto loan debts are increasing. You got now student loans of the younger generations, right? The legislation body of trying to mitigate the student loan repayment was not passed, so that failed to go through, and then students are going to have to, graduating students are going to have to pay that back at full. So I think people are getting more and more comfortable living in debt, and therefore are not concerned about that. And I personally, I think this is also a lot to do with what is your viewpoint of how the government is dealing with debt? As Stefan is saying, if the government keeps on employing people when it's got so much debt, and the government bails out companies, bails out banks, provides credit lines to support the customers, they're like, well, okay, I've got cover. The government's going to protect me, so I'm okay to go forward. And whether that's obviously a bit of an exaggeration, but that notion of how things are operating is trickling down into the consumer mindset, coupled with all the positive news. So I think we're getting. It's going to be quite an interesting couple of months going ahead and seeing how the Fed operates. And I think they're really in a tight spot. And the language that Jerome Powell uses in this meeting is going to be fascinating.
What's your views on
Go ahead.
on PacWest, the bank? Another bank just went under. And anybody have a view on that or insights? It's like, again, deposit crisis, over leveraged, got bought out by Bank of California. Anybody, and it's quite a large lender, right? And quite a big bank, Pacific Western.
I don't know if did they go under, or maybe this was to.
Well, they avoided going under. Yeah, it was preventive, right? So, whoops, let's swap it under. Oh, Bank of California, and they'll take it over. But they were leveraged and had a lot of loans outstanding, and the only way they could, sort of bridge that was through the high interest rates that was provided through what's that staking pool that they have. The Fed has I can't remember the name of it. Damn it. Where banks can borrow short term against their hold to maturity securities. Anyway,
I know you're talking about, but I can't think of the name off the top of my head.
Yeah.
But I mean, isn't this part of the problem? If the Fed keeps raising rates, we could see more of these situations start to pop up again.
100%.
Oh,
right? Yeah, and that's going to continue, right? And Jerome Powell in the past has said we'll deal with these situations on a one-on-one basis, right? But it'd be interesting to see what happens there. I mean, I think the PacWest decline or collapse was something that we noticed a while ago. It was part of the original worrying bank when was it? When First Republic, Signature Bank, and Silicon Valley had troubles and collapsed. I think they were on that list of really being touch and go.
Yeah, I don't know if you saw the on the sort of the revenge or the binge idea. A bunch of bands now, after all that pent-up lack of touring during COVID, are having trouble getting tour vans and trucking stuff so they can go on their usual tours across the United States. And so there's a glut of, a backlog of bands wanting to tour because everybody's going out this summer especially. And on that note, I'm not sure if you saw it, but the Philadelphia Fed cited Taylor Swift's tour as being a a major
Boost to the
economic
economy.
indicator. Yeah, it's hilarious stuff, man. We're in a brand new world. Before we go too much further here, let me also shill our spaces. You're listening to Truflation.com, Twitter Spaces. Ahead of today's FOMC meeting and Powell's presser, we do want your questions. So get in here, request us in the lower left hand of the app there. It says request to speak. We'll get you up here. Hang in there. And if you're also not wanting to speak, you can add us right below the link on X here. To get the global perspective, let's head out to the Holy Land. Let's go to the Israeli Blockchain Association and the executive director, Yosef Chantal. You've been listening in kind of patiently here, Yosef. What's your take, brother?
First of all, great to be here. But the reality is that I want to kind of play the devil's advocate because Fed doesn't really like to surprise people. We all know that. But for some reason, Truflation followers voted that 25% of us said that the rate is not going to go up. And I just want to kind of say our reasoning as to why we think so. And so do I, by the way. I also think that Fed is not going to raise the rate. They are going to surprise us. And the reasoning behind it is very simple. I mean, we forget, our short-term memory forgets a very, very powerful speech. I'd say that it's the most powerful speech that J. Powell gave throughout the year. And that was the prank call when he thought that he was talking to President Zelensky a few months back, right? And that's when he said, basically, yeah, we're probably going to do one or two raises, and then we're going to stop for a while just to see how it unfolds. And I'm a believer that, I think the inflation numbers, the CPI numbers dropped better than they had expected. That's for sure. And I see that next month, nobody's going to really ask them a question about the rates. So they might just let this one slide and say, you know what, let's give it like a 3 months, like a one full quarter to see that if we don't raise interest rates, what's going to unfold. So then afterwards, we can decide whether we're going to be more hawkish or we're going to be more dovish with the economy. Because if we see that during this break, inflation kind of picks back up and starts showing some crazy numbers, then I see them basically go and making some additional rate raises throughout till the end of the year. If we see that during the summer month, the inflation is kind of contained and it's not really moving anywhere, or the deviation is very minimal to what's expected, then we might say, okay, guys, did this like pilot test for 3 months, and it looks like we can survive this. So I'm I guess I'm playing the devil's advocate because there's a 99.99% chance that they're going to raise the rate. But I do believe that this time around, they're actually going to let it slide and just going to say, you know what, let's just see how it unfolds over the next couple of months, the summer month. And
go ahead.
That's what, I don't know if it's, that's kind of the gut feeling, let's call it, that I'm having. And also like some of the folks that I speak with, because everybody's expecting the raise, like markets, Wall Street, everybody is. And I do think that this is like on a grander scheme of things, basically. Let's not forget also that, there is elections coming up, at which point, in 2024, before elections, from September till, 2024, all this month, they're going to make sure that, certain individuals do not get elected for one reason or the other. And I do believe that that's going to be, this break will be a good test for them to figure out if they should really like do something super aggressive to contain the inflation, or they can just make it slow and easy for people to kind of feel the impact a little bit and just, ease up a little bit on them.
Yeah, if you scroll down, Yosef was referring to a little poll we did on X yesterday. And we got about 1,400 votes, give or take. And, the consensus is, 77.5%, which, obviously is expected. But in true Truflation fashion, we have to be the the contrarians. 22 point something percent, whatever the math works out to be, 0.5%. We're saying that he will not raise rates, or the FOMC will not suggest a rate raise. So that's super interesting, and the impact of that will just be, I can't even imagine. If anybody wants to speak to that, before we do have a listener question here. It's Husker X. Husker X, you're up. You've got an all-star panel. You've got the CEO of Truflation, head of data, Ivan Yelik. You've got Oliver Rust, our head analyst, head of product. Yosef Chantal, you just heard from the Israeli Blockchain Association. And of course, Jonah Lupton of Lupton Capital, investor trader. Husker X, go ahead.
Yeah, I just wanted to ask you a question about, you guys were talking about the federal government being one of the bigger employers of the U.S. And one thing that I thought was interesting is that the current administration's proposal to increase government salaries by 8%, along with, I think Social Security is trending at maybe like a 4 or 5% increase. I mean, with those two factors, I've read that the GDP actually includes government salaries, and I'm just wondering if the impact that an increase like that has on GDP and inflation numbers. Because historically, I look back, and the last time we had these kind of dynamics would maybe be like the 70s or 80s, sometime around there. So I guess my thoughts are like you could artificially increase GDP and which would feed inflation, and you could potentially not ever really have a recession because the government is stimulating itself.
Yeah, that's a really good point. That's sort of implicit. Anybody can take that one. Is the government goosing the numbers by just hiring people to, fill holes?
Well, let me try and answer this one, because my point is basically that the focus in future months will be more on the labor market than it is on inflation. And speaking of that, if you look at the government numbers of hires and job openings, those are pretty high. But on the other hand, the layoff numbers or total separations that are presented by the government are quite steady. And what's interesting, it's always to look at the alternative data sets, and that's what Truflation actually is doing at this point. And if you look at some other metrics like Warren Tracker or Warren Notices that track the announced layoffs, which has a delay of 60 days, those are for the past 6 months well above the level of the last year. Additionally, if you look at the report from Challenger Gray and Christmas, also on job cuts, presents that in the last 2 quarters, the numbers are higher than the last year, which means that basically the announced job cuts or layoffs are in raise, and that goes down the line what Husker X mentioned, that is it possible that the government is artificially pumping the salaries but also pumping the numbers by hiring in government artificially? Maybe, but one thing to focus in and look more closer, and that's what actually Truflation is doing, is the labor market, to try to identify real data sources that are not based on surveys again, but that are based on real layoffs that are happening. That's just my 2 cents on where to focus in next quarter.
Yeah, I guess my question was more long term, maybe the quarter by quarter, but I'm just speculating that it'll be hard to get GDP down and cool off inflation if your major employer increases salaries by 8%, every year.
That is correct. That definitely, you cannot fight that, or any kind of layoffs will have an issue fighting those numbers. But on the other hand, I do believe that there will be a limit to that, and that if layoffs start to go even higher, we'll have a potential issue there.
Great question. Oliver, do you want to say something?
Yeah, no, my only comment on top of that is just to say, I think yes, they're adding the government by hiring additional people and asking for an 8% salary increase is obviously adding incremental pressure on the inflation, because that then incurs a greater confidence, improves purchasing power, and blah, blah, blah. right? So I think that's not going to help them, or help the FOMC try to contain pricing, accelerate pricing pressure on a downward trajectory. I think, though, the question is, what's the balance going to be versus the increase they're increasing and the number of employees they're bringing on versus what the markets are going to expect for, right? And then historically, if you've looked at interest rate increases versus unemployment versus S&P 500 performances, historically, this is by far the fastest acceleration of interest rates we've seen in the last 40, 50, 60 years. And then second of all, when you start to see unemployment hit around 4.5% is when you start to see the S&P numbers come down, right? Now, it's not 100% accurate, so don't quote me on that, and don't take any investment advice from that viewpoint. But just looking at those stats, it starts to hit around 4.5% where you start seeing these numbers starting to change. And I think that's where the centrist view of the people I bucketed in from the Fed with Michael Barr, Jerome Powell, I think that's where they are thinking of, is trying to ease and cool the labor market to get it to that level. And then the market will take care of itself, so to speak. But yeah, the government certainly is not helping that, and I think they're just delaying the inevitable.
Yeah, some people describe it as kind of like the slinky effect. It sort of kind of makes its way out. The people who get those inflated dollars first obviously benefit the most. We do have another listener question. JRL, you are up with our all-star panel here. Go ahead and hit us.
Hey, thank you. Yes, I'm a financial advisor, just a retail guy, so I'm, basically a regular guy, but I get to kind of talk to people about this all the time. And I put my hand up when I heard somebody say that they think the Federal Reserve is going to potentially not raise rates today, and I love that. That would be very wishful thinking, I think, because I guess a month ago or so, the last time when they didn't, they sounded really pretty hawkish. And I was kind of being hopeful in the same kind of place, saying, my thoughts are that they don't want to make it sound like they're done, right? They don't want to spark any kind of euphoria in the markets and get the prices to run up. And I think with a 99% chance or expectation that they're going to raise rates, that would have that kind of an effect where surprise, and then the markets jump real high, and it causes some of those same problems that they want to avoid. So I think it would be in their interest to try to, wouldn't it be great if a month from now we were at 50-50? We didn't know what they were going to do. That wouldn't be too bad. So that's my thoughts on that. Maybe not raising them today.
Yeah, Joseph, from your mouth to Jay Powell's ear, what do you say to JRL, who says, "Man, if he does that, he's gonna spook the market and everybody's gonna pile in"? What do you think?
I agree with him 100%. That's why, maybe it's like wishful. I even said that it's like wishful thinking, and it's more of like a gut feeling, because it's priced in. And Fed, as I said, Fed, they're very conservative. Have always been conservative in the sense that they don't like to bring change to the market. But then on the other hand, it's just it sort of makes sense for them to give a summer break to raising, and maybe they just want to do the summer vacation for a while and just not surprise us in the market and just see how it all plays out.
I hope you're right. That's what I'll be hoping for as well. The analysts I listen to, they've done a good job. I remember at the peak inflation, they were telling us by the end of the year it's going to be 6.5, and they nailed it on the nose. And their estimate, I don't remember their estimates by the end of the year, but they were saying that they'd expect it to get back down to 2% by the end of next year. So if the Fed would just have a little patience, I think all this would be fine, and we wouldn't have to be worried about a recession. But we'll see what they do.
I mean, that's how I feel too. I mean, I've been critical of the Fed just because I think they've gone too far. I don't understand why they have to keep raising rates with inflation coming down. I just feel like they're risking going too far, over tightening, strangling the economy, and then we start to see, significant job losses. It feels like right now they've sort of navigated a perfect soft landing, if they just stop raising rates and show a little bit of patience. But they seem determined to go too far, and they seem determined to keep raising rates until inflation is close to 2%. And I just don't know when core CPI is going to be under 2%. I mean, back to my spreadsheet. Core CPI, if we hold on one second. I think we're going to have, so if month over month core averages 0.2% for the rest of the year, the next 5 months, August through December, that'll get us under 4% for core, but probably not under 3.5%. So I just don't know what the Fed's going to do. I mean, are they going to hike 25 basis points today and then pause and just stay at whatever that is, 525 or 550? Or are they just going to keep going until core is under 3%, closer to 2%? I mean, that could be sometime next year.
Yeah, we're definitely. Go ahead, Oliver.
Oh, no comment. I mean, the only comment I'd say is I tend to agree with everybody's comments, right? I'd love for the Fed to not increase interest rates this month, and that certainly, in my view, is certainly wishful thinking. But the only rational thinking that I can come up with they want to do that is because the labor market's too hot, right? And that's fueling spending, demand, everything else. But I think there's so many other factors, and in the economic environment that we are today, it's changed so much in the last 36 months that I don't think the traditional metrics of what we've used to measure the economy is probably the same metrics we should be using going forward, because so much has evolved. Where the supply chain disruptions we've had because of the Ukraine war, COVID, the quantitative easing we had just during the COVID years, all these factors are changing the way the economy is working and what's left in the supply chain system. That I think. I'd love for them not to increase interest rates, but I believe I'm of the firm belief in looking at all the voting members that this is going to go another 25 basis points. The question really is going to be what is the wording that Jerome Powell is going to be using? Because I agree with Joseph that the Fed and Jerome Powell is specifically concerned around this, is he doesn't want to be seen as flip-flopping, and how do they react to that 25 basis points, and what's the wording he's going to be using in this one to dictate whether this is the last increase? And I think this should be the last one. I think at every data point, they shouldn't be increasing here already. But if they do, this has to be the last one they do.
I just don't understand how they can talk about lag effects and then act like they don't know about lag effects.
Right.
Yeah, but I would say that's only a minority of the board that believes that, right? That lag effect, right? A lot of them, others don't believe that lag effect is what Bostic believes, which is 12 to 18 months, right? And he's of the viewpoint that they need to curb it now, whereas others are, suddenly, I can't remember if it was yourself or someone else who mentioned it, who suddenly mentioned, oh yeah, but core inflation is still at 4% or 4.8%. We need to cool that down. Forget about the top headline number. Let's now look at core inflation. So, it's very mixed messages that's coming out individually from, and this is what my whole point was. I think the voting members, the 11 voting members of the Fed are increasingly having a diverging viewpoint of what's to be happening, which is putting the Fed in a very difficult position, and Jerome Powell in particular, because in the last 12 months, they've had a very uniformed and consistent messaging across all the voting members. And we don't have that pattern anymore. So I think they're entering a tough time at the moment.
And before they go on vacation to Kennebunkport or Martha's Vineyard, do they just want to relax for the next month? Could you imagine if he does a mic drop and doesn't raise or doesn't meet expectations? My goodness, that'll just blow everything up. But very, very interesting discussion. We shouldn't let you go, Jonah, here before too long without asking for maybe what you're looking at in terms of stocks. Obviously, it's not financial advice, all the usual disclaimers there. But, you're a trader, you're in there, you're day-to-day mixing it up. What do you see? What do you like out there? Maybe drop some alpha on us.
So I don't trade mega cap tech. I'm mostly growth stocks. I'll trade some large caps, mostly mid caps. Like that's kind of my sweet spot. So like I mentioned early, Celsius is my largest holding, still one of my favorite picks right now, even going into Q2 earnings, even after the big run the stock has had, because we just got the recent Nielsen data. It shows that they're growing in the U.S. retail sales 160% year over year. Now, that doesn't include Amazon, that doesn't include Costco, that doesn't include international. So when they report Q2 earnings,
And this is an energy drink, right?
Yep. The blended year-over-year growth rate on revenues will be less than 160%, but I think it'll probably be around 105. It was 95% for Q1, and the stock gapped up. If no one's familiar with the company, it's an energy drink company, the third largest energy drink company now in the U.S. behind Red Bull and Monster. I don't think a lot of people realize that energy drinks is an $80 billion global market.
Wow.
Celsius has like just a tiny sliver of that globally. I think they're now up to about 6.5% in the U.S., but energy drink market is growing at about 9% a year. Actually, right now it's growing faster than that. It's growing double digits because of price increases. But I think if you look out over the next 5 to 10 years, it should grow about 8 to 9% year over year, which means it'll double in 8 to 9 years. So 8, 9 years from now, it's probably a $160 billion market, if not bigger. I think Celsius has 4, 5, 6% global market share at that point. So I do think Celsius has a chance to be the next Monster. Monster is a $60 billion company right now. They'll do about $8 billion in revenue over the next 12 months. I think Celsius could get there over the next 6, 8, 9 years. So even though it's up 10x over the last 3 years, I think it has a chance to 5x from here on the back of that Pepsi distribution deal. So Monster has been public for over 20 years. They've only had 1 year where they grew faster than 50%. Celsius is about to do it for the 4th straight year. So it's like, I mean, Monster has had a phenomenal run, but I mean, no energy drink company has ever done what Celsius is doing right now. So I remain bullish. Analysts are at 272 million. Actually, no, they just raised it. So analysts are at 272 for Q2. I think Celsius probably comes in above 300, maybe as high as 315, depending on what Amazon, Costco, and Sam's Club contribute. But I definitely think this is going to be a winner for the second half of the year. And then other stocks that I'm pretty bullish on going into Q2 earnings. Obviously, I'm talking my own book here, but Uber. So Uber, I mean, everyone knows Uber. They're the largest ride-sharing company in the U.S. And the reason I'm staying bullish is just because of the airline reports. You know, travel, like we talked about before, travel remains very strong. And Uber makes a boatload of money on those airport trips to and from. And then when you're traveling to a city, you know, how do you get around the city? You know, how do you get to meetings and whatnot? You know, you're using Uber. So as long as airlines keep reporting strong numbers, that keeps me pretty bullish on Uber. And I just think Uber's, it just, over the next few years, we're going to see growth slow down, top line will slow down, but margins continue to expand and free cash flow is really the story there. So Uber should do probably 2.5 to 3 billion of free cash flow this year. I think they could do as much as 5 billion of free cash flow next year, unless we run into a bad recession and travel falls off a cliff, in which case, you know, Uber would not be the best stock to hold.
That's Jonah Lupton of Lupton Capital.
And my third pick, SMCI. So Supermicro, they have partnerships with NVIDIA and AMD. NVIDIA obviously gets all the glory around AI chips. TSM reported earnings last week and said they expect AI chip demand to increase by 50% a year for the next 5 years. That's obviously good for NVIDIA and AMD if AMD can actually get some AI chips into the market. They don't have them yet. But whatever's good for NVIDIA is pretty good for Supermicro as well. So SMCI is the ticker symbol. They pre-announced, so they just wrapped up their 2023 Q4 earnings. So that ended in June. They're now into fiscal year 2024. When they report earnings in a few weeks, we'll get their fiscal 2024 guidance. But they just announced last Friday, they pre-announced their Q4 fiscal 2023 numbers. They raised the midpoint of their EPS by 38%, so increased midpoint by 38%, increased the low end of their EPS for Q4 by 50%. That means, and they said they're crushing it. I mean, they said demand is off the charts. that means that their fiscal 2024 number, their guidance, is going to be way above consensus. So I was loading up on SMCI last Friday as soon as I saw their pre-announced Q4 numbers, because I expect them to give us some really, really bullish 2024 guidance when they report in a few weeks. So just the stock's had a big run the last couple of years. I get it, but I mean, so has Nvidia. So have a lot of other semiconductor companies. Nvidia is trading at probably 45 times next 12-month earnings. SMCI is trading at 20 times next 12-month earnings. So I just think SMCI is sort of a bargain at these prices, despite the fact the stock's up like 300% in the last year. But it's justified.
It's kind of a broad range of businesses. Very, very, very cool. That was Jonah Lupton of Lupton Capital. Jonah, how can people follow you, follow your work?
So Lupton Capital, I mean, I don't manage any outside capital. It's just my money that I run. And then I have a couple investment services. So I have a stock twits room, $20 a month. You get both of my portfolios, all of my activity, all my market commentary, all my performance. And then I have a Substack where I send out my research every week. I do a deep dive every week on a small cap, mid cap, and large cap. And just so everyone's familiar, so my investment portfolio is up 100% year to date. My trading portfolio is up about 70% year to date, which is why I'm a little bit more cautious right now going into Q2 earnings. I feel like a lot of these stocks have had a big run. They need to take a pause, a breather, whatever. And that's why I've been trimming positions and adding some hedges, just because I don't want to lose 15, 20% over the next couple months as we go through earnings. I'd rather raise some cash and then reevaluate things after we get through earnings season.
Very cool. And Yosef Shaftal of the Israeli Blockchain Association. How can people follow your work and what you're doing going forward?
Well, what we do is we basically work with startup founders a lot, and that's our passion, is innovating technologies and the next generation of tech. So most of the times, people don't find us; we find them.
Very nice. Well, there it is, ladies and gents. We do return on Wednesday, August 9th at 9:30 a.m. Eastern time, for an AMA right here with global macro investor and Real Vision CEO Raoul Paul. So please set your reminders. You can keep up with Truflation on all of our socials here on X, Telegram, Discord, YouTube. We are everywhere. Give us a follow and you'll stay in the loop. Thank you so much to the Truflation team, to Jonah Lupton for coming on, Yosef Shaftal. Thanks, everyone. Also to the great questions. What a fun discussion. And again, we'll see you back here on August 9th for an AMA. Thanks, everybody.
Thanks, guys. Have a good one.